Hello, it's Jonathan Wellum of Rocklinc Investment Partners, and it's May the 6th, 2020, coming to you with another investment update. Now, this investment update is going to be a little bit different. We're going to, first of all, I'm going to give you a quick overview of what's happening in terms of Rocklinc and our performance, and sort of just a quick comment in terms of the markets. But for the majority of the presentation, the back half of it, we're going to be talking with Peter Grosskopf, who is the CEO of Sprott Inc., which is really a global leader in the whole precious metals market in that whole area. And we're excited with the prospects of talking to Peter, learning a bit more about Sprott, about some of the innovative things that they're doing, and how they view the precious metals market going forward. So let me just give you a quick overview in terms of Rocklinc and where we stand and what's been happening in terms of our firm. The next slide that you're going to see there in terms of the slide presentation will be a disclaimer, and that's important from a legal perspective to bear in mind all of those things that are on that page, and I'm sure you're going to read it intently. The next slide just gives you a quick overview of the presentation today. And first of all, I'll give you just an overview of Rocklinc again, investment challenges, our strategy and positioning given the current market conditions. And I'm going to just give you a quick update in terms of our portfolios and our performance, how we've been doing year to date up until the end of April. And then our next webcast, I'll just announce that we're actually going to do another webcast on June the 11th, and that will involve both Andrew Chang and Jesse Vandermeer, my analysts, and we'll focus on some of the companies that we have. But for today, after I give my brief overview and update in terms of Rocklinc, we're going to be talking with Peter Grosskopf of Sprott Inc., and we're really looking forward to that. So let's just move through the presentation now. The next slide, just an overview in terms of Rocklinc. As we have told our clients, we are a private investment company, as you know. We have about $160 million in assets under management, and we've been blessed with continual growth through all of this period, signing up lots of new accounts. We have approximately 140 households now. And as we've talked to you before, we invest based upon independent thinking, deep understanding of the investments, looking at current realities rooted in a view of the past and in history, and then also looking forward in terms of opportunities. And we try to use an interdisciplinary approach. So we take a worldview approach, not just following what other people do. In terms of our investment philosophy, as we go through every presentation, I want to emphasize this to everybody. We're buying excellent companies. We run focused portfolios. We're not index investors. We're not passive investors. We're active investors. We have long-term holding periods so that we can do tax-deferred compounding. That's the way wealth is ultimately created. We purchase at a margin of safety. We want to be careful about valuations. And we want to understand the economic backdrop. So today, one of the most important things to understand is, just what's going to happen in terms of the long-term implications of this lockdown and our response to the coronavirus. On the next slide, just investment challenges, which we again are reiterating. These have not gone away. If anything, they've intensified given the current conditions and what we've seen so far this year. Global debt, and it is excessive, and it is growing at unprecedented levels. Unfunded government promises. Our governments have promised things they cannot deliver, and my goodness, those promises have just escalated. If anything else, they've just escalated the last couple of months. A lot of what we're seeing here out of governments is complete economic folly. It's insanity. The demographics are, of course, stressing the whole situation of aging populations. We have lack of family formation. The monetary policies, the response to these challenges has been, again, unprecedented. We've been talking about money printing for some time. It's been going on really for the last 10, 12 years. And we've been talking about low interest rates and negative interest rates. And my goodness, over the last 8 weeks, we've just seen money printing at scale that we've never seen in human history. It's unprecedented what we're seeing right now. And then the whole coronavirus, COVID-19, whatever you want to call it, the lockdowns, and the implications of that. Now, I did a whole presentation on this that I sent out to our clients about a week and a half ago, and so I'd refer you to that because I went into detail of what I believe are the unintended consequences and some of the challenges coming to us as a result of the whole policy of locking down, which I think is really the most dangerous economic and social policy we have seen in history, and we are not going to escape the effects of that on our economy and in our society. In terms of our strategy and positioning, on the next slide, you can see just briefly, we've talked about this before, we have minimal exposure to financial institutions. We're in a debt crisis, and we don't want to own companies that are stacked full of debt at the end of the day. So you don't have much in banks or life insurance companies. In fact, we've even trimmed what we did have, so it's pretty small. Minimize exposure to economically sensitive commodities. So we're not in a lot of the commodities that require a rip-roaring economy. Oil would be an example. We have very little exposure to oil. Minimize exposure to consumer discretionary businesses. Those are ones where the consumer doesn't really have to spend the money. They're not essentials, they're not staples. And we believe the consumer is going to be strapped for some time and is going to be very careful and is not going to be jumping on cruises and taking long-term holidays and hanging out in hotels. And so there's certain businesses that we are a long ways away from. And there's systemic changes that have taken place. We've seen this in a number of industries, and we do not want to be there until there's better clarity. We also are maintaining healthy exposure to precious metals, gold, silver, and we're going to hear more about that when Peter Groskopf joins us in a few moments from Sprott Inc. And that's one reason why we have Peter joining us. It's probably one of the largest areas of exposure now in amongst the Rocklinc portfolios, and it's there because it's a hedge. We're very concerned about the economic situation. And then continuing on strategy and positioning on the next slide, we maintain significant positions outside of Canada. In other words, we'd like to have more US dollar exposure, and we're concerned about the Canadian dollar longer term, both because of our weaker economy. Our commodity sector, our oil sector has been hit hard. Governmental policies in Canada are certainly not favorable for business, and so we're concerned about a weaker dollar. Sixth, maintain equity weightings in core businesses with strong balance sheets that are essential to the economy with substantial moats. And when I say moats, again, protective elements around the business, so it's hard to have new businesses come in and compete against them. We maintain liquidity. If anything, we are not investing very aggressively. We're maintaining cash. I agree with Warren Buffett. There's so much uncertainty that having some cash is going to be very, very opportunistic if we retest lows or we get more market volatility on the downside as we enter into the summertime. We want cash. We want to be opportunistic and take advantage of that. And then be patient. I mean, I really tell our clients, listen, be patient. We're in the early innings. We're early innings here. We've never done a lockdown. We've never destroyed the kind of jobs we've destroyed. We've never printed the money that we've printed in such a short period of time. We've never run up the deficits and added to our debt at the rate that we've done. It is totally unprecedented, and there are going to be implications. Again, go back to a presentation I did just a couple weeks ago in terms of talking about the unintended consequences. We've seen just massive intrusion of government into every aspect of our life, and this should concern all of us. Now, when we look over at the performance summary on the next page, this graph that goes up, it's fairly busy, so I just want to point you to a couple areas. First of all, this is our overall book of business. So this includes all of our accounts because everyone's account is slightly different, and so we've put them all together here. And this is after all fees. So I would draw your attention to the year to date. That's YTD. If you look there, year to date, you can see that our overall investors are up 2.8% after all fees at the end of April. So that's actually, we're ahead this year. We're up for the year. And that's, when you compare that to the TSX, which is the Toronto market, you can see it's down 13.4%. We can see the S&P 500 total return is actually down 9% plus. And then the bond index is actually up because interest rates have come down. We don't have really too much exposure into long bonds. But you can see that we've literally trounced the indexes. We are way ahead of the indexes, and we're very happy about that. That's not easy to do on a sustainable basis. If you go back 5 years, so that last column, it's important just to point out that we've been compounding at 8.2% a year, and that's with about 30 to 35% in cash. So that 8.2% is with a large amount of cash in the portfolios across all of our accounts. And you can see that we've easily beaten the TSX, which hasn't even had a positive number over the last 5 years. The S&P is up about 9%. And so our number is slightly behind the S&P, but remember, we have 35% cash, and we also have half of our assets in Toronto. And so our U.S. holdings have actually outperformed the S&P by quite a large measure. And so you can see that overall, over the last 5 years, again, we have significantly beaten the indexes. And if you look at 2 years, you can see that that's even larger. So the last couple of years, we have really beaten up on the indexes. On the next slide, I just point out our Rocklinc Partners Fund. We started this a little over 2.5 years ago in September of 2017. We haven't talked about it too much. A number of our clients own it, and we're probably going to use it a bit more. But I wanted to point out, we started this quietly because we just wanted to build a new little business within our overall business. And again, this is after all fees. If you look at the year-to-date numbers there, you can see that our fund is actually up 5% year-to-date. And that's with 25% cash. So we've been carrying 25% cash in this fund. It's up 5% year-to-date. And again, you can see it's literally trounced the indexes by a large measure. If you go to the 2-year number, again, this is an annualized compound rate of return over 2 years. We're actually running 14%. And again, we've trounced the Toronto market, which is negative 2%, 2.7, and we've trounced the S&P 500 also by a large measure. And so we're very pleased with the performance. And then on the next slide, we just point out, and you can look at that at your leisure, if you want to see how our stocks have actually performed. This gives you the breakdown of the performance by asset allocation. So it looks at the bonds, looks at our Canadian stocks, our U.S. stocks. And you can see there that our stock performance has really beaten up on the indexes. I would suggest that this fund probably would be in the top, 3-4% of all funds in Canada from its start. So it would be right at the top of the list. Again, it's quiet. We've only used it for our own clients, but we're looking at this as an opportunity to expand our business going forward. And so I just wanted to give an update there as we're getting closer to our 3rd year in running this fund. So overall, we've been very fortunate. You have been very fortunate in terms of performance. And it's not going to be easy, I think, going into the next number of months as we live through the implications of what we have just seen here over the last couple of months. These lockdowns and the shutting down of large swaths of our economy is going to have long-term impact. Our next webcast is going to be June the 11th, and that'll be back to our traditional webcast. And then now we're going to get ready to speak with Peter Groskopf. Before we link him into this presentation, I've just put up there a bit of a bio of Peter's. Peter is the CEO of Sprott Inc. It is a leader in the global precious metals market. He's been at the helm of the company now for close to 10 years. And he's got an extensive background in investment banking, well-educated. And I've known Peter for the last number of years and have great respect and admiration for the leadership he's provided at Sprott and the focus that they've brought to their business over the last number of years. So with that, we'll prepare for Peter to join us in just a few moments. Thank you very much, and we'll be back to you shortly.